Something happened this week that most people will look back on. The New York Stock Exchange and Nasdaq, the two institutions that define how America trades, both announced crypto partnerships on the same week with completely different strategies. And that's not even the biggest story. The US Senate finally broke months of gridlock on the Clarity Act, a bipartisan deal on stablecoin yields. The banks won, Circle dropped 20% in a single session, and the fine print tells you exactly where the US financial regulation is headed for the next decade. I'm Mark, this is 51 Insights, and this was one of the most consequential weeks in institutional crypto since the spot ETF approvals. I just got back from DAS New York, which was noticeably more institutional than last year. Let me walk through what happened and what it actually means. So let's start with the Senate deal because it sets the context for everything else. Senator Tillis and also Brooks cut a bipartisan deal on stablecoin yield. The terms are simple. No passive yield on stablecoin balances. Nothing economically equivalent to interest, but rewards tied to actual activity, transactions, loyalty, platform usage, those stay legal. The SEC, CFTC, and the Treasury get 12 months to figure out where exactly to draw that line. And here's something that doesn't get discussed enough. The American Bankers Association argued that unregulated stablecoin yield could suck $6.6 trillion in deposits from the banking system. That's the number that moved the votes, not innovation arguments, not consumer choice arguments. $6.6 trillion in potential deposit flight. And when you understand that, you understand why Circle fell 20% and lost $5.6 billion in market cap in a single session. And why Coinbase dropped 11%, with stablecoin revenue representing roughly 20% of its quarterly income. The passive yield ban is the price crypto platforms pay for the rest of the bill to move forward. Think about what that means. The crypto industry has been begging for regulatory clarity for years. They're finally getting it. And the cost of that clarity is surrendering the single most profitable product in the stablecoin ecosystem. Senator Moreno has warned that if the Clarity Act doesn't reach the Senate floor by May, crypto legislation risks going dark until after the midterm cycle. So there's a clock on this. And something else happened quietly alongside. The White House completed its review of the Labor Department rule that could formally permit digital assets inside the $10 trillion 401k market. The administration's crypto posture is moving on multiple fronts simultaneously. Now here's where the week gets really interesting. While Nasdaq and New York Stock Exchange both announced crypto integrations, they have fundamentally different theories about what's happening to markets. And the disagreement itself is the story. Nasdaq integrated Talos, digital asset tools, into Calypso, its risks and collateral management system used by banks, hedge funds, and asset managers globally. The target, an estimated $35 billion in excess collateral stuck in non-interest-bearing accounts because crypto and traditional systems don't talk to each other. Nasdaq is saying, take the existing infrastructure, add crypto to it. Retrofit. New York Stock Exchange took the opposite approach. They named Securitize as the transfer agent for a planned digital trading platform. This is a 24/7 menu for tokenized US stocks and ETFs with same-day settlement and stablecoin funding. Not derivatives, not price trackers, actual shares issued on-chain with full legal rights, settlement finality, and shareholder protections. They're targeting a late 2026 launch pending SEC and FINRA approval. So Nasdaq is upgrading the existing system. New York Stock Exchange is building a new one. Both are betting that digital and traditional assets end up inside the same infrastructure. They just disagree about whether you get there by renovating or by starting from scratch. That disagreement is going to define market structure for the next 10 years. If you run a trading desk, a custody operation, or a compliance function, your answer to that question determines your technology roadmap. Franklin Templeton just partnered with Ondo Finance to Templeton just partnered with Ondo Finance to tokenize 5 ETFs spanning US equities, high-yield bonds, and gold. A top 10 global asset manager outsourcing tokenized distribution to a crypto-native platform. That's a first. The structure is worth understanding. Ondo holds ETF shares in custody and issues wrapper tokens. Counterparty risk sits with Ondo, not Franklin Templeton. The product trades 24/7 through crypto wallets, no brokerage account required, launching first across Europe, Asia Pacific, the Middle East, and Latin America. US availability depends on further regulation clarity. And here's the hidden implication. The total on-chain tokenized stock market just crossed 1 billion. Ondo Global Markets alone holds over 700 million, commanding roughly 60% market share. This deal isn't really about giving existing investors a new way to access Franklin Templeton's ETFs. It's about reaching wallet-native investors across emerging markets, never brokerage clients in the first place. And the local brokers, correspondent banks, and fund distributors who charge for that access are the ones getting disintermediated. Next one. Coinbase and Better just launched something that would have been unthinkable 2 years ago. A product that lets homebuyers pledge Bitcoin or USDC as collateral on a Fannie Mae conforming mortgage without selling their crypto, triggering a capital gains event or facing margin calls. Rates run 0.5 to 1.5 percentage points above a standard 30-year. If Bitcoin drops, mortgage terms don't change. No additional collateral required. The only liquidation trigger is a 60-day payment delinquency identical to a conventional mortgage. So, what does this mean? Pledge assets, borrow against them, never trigger a taxable event. Private bankers have done this forever. What's new is who gets access. Fannie Mae's conforming standards backstop 25% of all US single-family mortgage debt. And this just opened to anyone with qualifying crypto. And it didn't happen by accident. Look at the sequence. The SEC ruled stablecoins aren't securities in April 2025. FHFA told Fannie and Freddie to accept crypto reserves in June. JP Morgan opened Bitcoin and Ether as loan collateral in October. CFTC approved crypto for clear derivatives margin in December, and each step made the next one possible. So here's what you need to know. When Fannie changes its underwriting standards, the entire mortgage industry follows. This isn't a Miami fintech experimenting with crypto mortgages for the ultra-wealthy. This is the US government's mortgage infrastructure saying crypto is a real collateral. And then one more story that deserves your attention. MoonPay launched an open wallet standard for AI agents and open sourced it. PayPal, OKX, Ripple, Circle, and the Ethereum, Solana, and Ton foundations all contributed. And here's why this matters. 3 payment protocols for AI agents shipped in the past month. Coinbase X4012, Google's Agent Payment Protocol, Stripe and Temple's Machine Payments Protocol, and all 3 assume agents have a wallet. None of them define how that wallet should work. MoonPay built the missing piece. The standard lets AI agents hold value, sign transactions, and pay across 8 blockchain families without exposing a private key. MoonPay doesn't charge for the standard. They don't need to. If open wallet becomes the default, every agent that funds a wallet or bridges chains hits MoonPay's own ramp. They basically gave away the pipes to own the meter. All right, some quick hits before I go. The Basel Committee just published its first data on global banks' crypto exposures. The FSB flagged crypto risks and outlined 2026 regulatory priorities. Tether hired a Big Four firm for the first full USDT reserves audit. BlackRock CEO Larry Fink backed tokenization and cited roughly $150 billion in digital asset exposure. Invesco took over Superstate's $900 million tokenized treasury fund. Coinbase brought exchange data on-chain through Chainlink Datalink. And Ethereum is rethinking its scaling roadmap amid AI and quantum computing pressures. So, here's what I take away from all of this. The common thread across every story this week is convergence. Traditional finance isn't experimenting with crypto anymore. It's integrating it. New York Stock Exchange and Nasdaq are embedding it into the core infrastructure. Fannie Mae is accepting it as a collateral. Franklin Templeton is using crypto-native rails for distribution. The Senate is writing the rules that makes all of this permanent. As always, a full analysis of everything I covered today is in this week's Field Notes. Pro subscribers get the deep institutional breakdown on Monday. Links are in the description. I'm Mark. This is 51 Insights. Thanks for tuning in and see you next week.